It's really important to ask yourself, how can I? How can I do this? How can I save $1 million? If you say, how can I, you're setting up the solution and the answers.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to another episode on Wealth Strategy Secrets. Our next guest is John Casmon. John is a distinguished real estate entrepreneur with an impressive track record of partnering with busy professionals to invest in over $100 million worth of apartments. He co-founded Midwest Real Estate Networking Summit, a must-attend event for anyone serious about multifamily. He's also the host of Multifamily Insights podcast and has become a valuable resource for those looking to delve deeper into multifamily real estate. In this episode, we discuss his transition from a career in corporate America to becoming a full-time real estate investor, also the power of multifamily real estate as an investment strategy and wealth building tool, and targeting the Midwest market and its current demographic. I hope you enjoy the episode. John, welcome to the show.
Hey, Dave, thanks for having me today.
Yeah, you bet. It's great to have you on the show, and I know listeners are really going to enjoy the discussion. So why don't we get started and talk about your journey? I know you kind of transitioned from corporate America, kind of got into real estate, and really interested to hear kind of how you made that transition for yourself.
Yeah, so I spent 15 years in corporate America doing marketing and advertising. So I worked at, General Motors at one point. I worked for different advertising agencies, and I loved what I was doing. But I kept running into this issue where job security was a concern of mine. So I was at GM when we went through bankruptcy. So I saw that firsthand, and that was really. I mean, I had a fellowship program before out of college, but that was my first real corporate job, right? Settled in. I'm working with a bunch of lifers. So for me, being at that kind of, that company at that time, it was important because you didn't see a lot of young people, period. And especially someone who looked like me. So I enjoyed my time there and actually really, enjoyed working at the company. But I watched us go through rounds and rounds of layoffs. And my father was blue collar as they come, right? He worked 2 jobs in his life, right? He worked for a Buick dealership. Ironically, I ended up working on the Buick advertising team, and he worked at a Buick dealership in the parts department. And then he worked for a steel company. So he's had 2 jobs. He's, that's what he instilled in me. It's hard work. You get a good job, you keep it, you work it until you retire. They get you to go watch. That's the mentality. So when I'm watching all these people get let go prematurely or being forced to retire early, they didn't have a plan B. And that made me realize that as much as I liked stability, the only way to truly create stability was to take control completely over your own financial future. So that got me interested in real estate. I would say I was already interested. That kind of forced me to say, you better figure out something else. So I started learning about real estate. I was still in Detroit at the time. So Detroit was not the best market or, depending on how you look at it, it was a great market to invest in back in 2009, 2010. But I certainly didn't have the confidence to think that I was going to go out there and do well investing in Detroit. So I moved to Chicago 2011, got a job at a small advertising agency. That company grew and I was a part of the growth of that company. And then I started investing on the side and I slowly started building up my own personal portfolio. And then right around the time when I was ready to scale and started working with investors and really growing this business, the company I was working for also went through bankruptcy. And that was scary, but it also pushed me to say, you were on the right path. This is the conviction you need to continue to pursue what you're doing. And that really kind of got me not just comfortable, but really helped me focus on not just investing in real estate and apartments, but going larger into apartment syndications and doing larger deals.
Yeah, what an interesting story. I know, for most people, there's always some kind of right epiphany that you have kind of along the way, right? That, gives you that insight to say, hey, I've got to move forward. I've got to really take action. And that really resonates with me, John. I came out of corporate America after the Marine Corps and had similar frustrations, right? In terms of, just being in this massive machine that you really didn't have all that much control over. And we falsely think that we have this job security, but in reality, there's a lot less, right? And so when you can kind of, make that paradigm shift and transition over to having, more control over your own destiny through, entrepreneurship as well as passive investing, it's really a massive shift.
Yeah, Dave, and I think too, like even if you like I loved my job. I know some people they just want to quit their job and they're miserable. That wasn't me, man. I had a great job. I was doing fun stuff, great activations.
Hmm.
I enjoyed what I was doing, but I also was very conscious of the fact that at any moment that job could be taken away. Or even if it wasn't taken away, they may ask me to do something that I don't enjoy doing. Right. And in corporate, especially at a big company like GM, like you have to sometimes check a box and make lateral moves in order to move forward. So I might have to go into the field and be a sales rep or things that I didn't enjoy, right? I didn't go to school for that. I wasn't passionate about that. And I started to realize like, oh, like now I have to play the game and do certain things that I actually don't want to do and do them for 2 years or whatever it is. And that just started to weigh on me, right? And I think that's the important thing too, is that you can love your job, but at any moment you may not love it or you may be pushed to do something else and you want to have that flexibility. And as you stated, passive investing, passive income, that doesn't mean you got to quit your job tomorrow, but it does give you options and it does allow you to focus on the things that are important to you and get kind of that clarity that you need so you can build a whole life, not just real estate. I know you talk a lot about, the holistic investment strategy and the holistic self, but that's what you're targeting, right? You want to be a great father, you want to be a great husband, you want to be a great, son, all these different assets or facets of who you are. It's hard if you're just focused on the W-2 and just grinding and grinding and grinding, So for
Yeah.
me, I think it was really important to create options to be the best version of myself, or at least a better version of myself.
Yeah, absolutely, John. I think you really create this, it's this freedom of purpose, that we're after and having that purpose in your life. Because when you have purpose, you're not actually working. And you can have purpose in corporate, but you have to be, careful, as you do it. And then, as you say, if you can kind of create this passive income that's coming in, it totally changes how you think about things. You may not necessarily have to be forced into doing something by knowing, you have options, like you say. So it's powerful.
Yeah, if I could share a quick little story, there's when I was at GM and we were going through bankruptcy, everyone had high anxiety, right? Like all of us, from the leader of the brands that I was working on to the junior analyst. Every day it was just it was tense. Everyone was on eggshells except one guy. There was one guy who every day this guy had a smile on his face. He came in, he worked from 7:30 to 4:30, right? And he did a good job, but he wasn't trying to get promoted. He wasn't worried about any of the political stuff. He just came in, did his job, had a smile on his face. And he was one of my favorite people at the company. His name was Jack. And I remember just talking to Jack and just kind of, off to the side. And I was a young guy, right? I was literally in my mid 20s. So, they when you're young like that, the older guys they're happy to pull you to the side and mentor you a little bit. And we would just chat and just have good conversations. And the one thing Jack told, or I learned about Jack, is Jack had other investments. He had property in Utah. He had other things that he did. He had a snowmobile, so he would take his family out and just spend a couple weeks a year, just skiing and on a snowmobile. And real estate was a thing that gave him that flexibility. So the reason he could come to work happy every day is because he didn't need it. He was there because he enjoyed the work he was doing. But if they told him, "Hey, your time's up," he'd be like, "All right, cool. I'll go go do the other stuff I want to do." And that was the thing that really struck with me. It wasn't his boss, his boss's boss, the people who were making the big salaries, the big bucks, because they had all the stress of this house crumbling down if something happened. And I watched that happen to a senior executive who moved from California to Detroit, and then within a year or a year and a half, they moved her and her family to Shanghai. and she had, high school kids. And I'm just picturing like, man, do I really want to reach that level where my kids may be forced to move states or countries, and not be able to make friends just because I'm chasing a promotion or a dream? And obviously you can say no and all of that, but it just made me really come to grips with like, which path do you want? Do you want to live like Jack, or do you want to live like this person who makes more money and has maybe the nicer things, but doesn't have that control of the time, the financial freedom, the flexibility that they're looking for. And that really kind of put me on that path to say, let's try to see how real estate can help us live the life we want to live.
Yeah, 100%. And did you develop a particular investment thesis or a wealth strategy as you kind of transitioned into the investing world?
I did. So I studied a lot. And, when you don't come from that place and you don't have a lot of folks who can teach you early on, you have to use all the resources available. And for anyone listening now, I mean, we're kind of blessed because you can Google pretty much anything you want to know, right? And you may need to double check sources, but the information is abundant, right? I mean, back in that time, man, I'm sounding like an old guy. Back in my day, but
what year is this? What year?
Yeah, it's not that long ago. It's like 15, 20 years ago, right?
Yeah.
So you can still Google, but it wasn't like everything was out there. But at that time, we still went to the library, right, to go get information. So I would get books, and I would check out books, and I would buy some books, but sometimes I would just go to the library and check out a book and read it. And it was from personal investments or personal development, budgeting, like all these kind of things. Because first I had to figure out how to make the money I had work. Then how do I grow the money I have, and then ultimately how to invest. And that was a path that I had to go on, and it was very helpful for me. But from an investment standpoint, real estate just made sense to me. I thought about, the people who I thought had money, and all of them basically had real estate, and there's that famous quote that 90% of the world's, billionaires, at least either make it through real estate or hold some of their investments in real estate. So real estate was something I wanted to learn early on. And once I got into real estate and started learning more about that, then everyone I read, or at least talked to, they talked about commercial real estate and multifamily. So I knew multifamily is where I wanted to go. And that's why we started with kind of a duplex, and, not the biggest, but it worked because, like a house hack, I lived in one unit, I rented out the other unit. Then we bought a 3-unit building. Then we bought an 8-unit building. And each investment was continuing to test this theory, right? The 2-unit, okay, I was living in one, renting out the other. For me, if I could have someone paying the bulk of my rent, because that's kind of how I looked at it. I was renting before. Well, if someone else is paying the bulk of my rent, I'm up, right? I was paying $1,500 in rent. I bought this 2-unit. The person on the first floor paid $1,400 in rent. My note was around $2,000. So my portion of rent was $600. So in my mind, I just saved $900, right, with this investment. Yeah. Even if it didn't appreciate or nothing else, I cut my rent down by $600. Obviously, it did appreciate and go up in value. And at that point, I'm like, oh, this thing really works. So then I did it with the 3-unit. Now I'm actually cash flowing. So I'm not just, getting my rent cut down. I'm actually getting money. I'm making money every month off of this. Then with the 8-unit, it was a matter of being professional and seeing if I can make this a real business, right? Now it's commercial multifamily. I have a professional property management company, which was mandated by the lender, by the way. But I have this professional property management company. So now I'm testing out these theories. I want to make sure it's not luck, right? I want to see like, okay, is this repeatable? And that one we ran into a few more issues, but it was great because I was able to confirm the things that I believed in. And at that point, that's when I decided to start scaling into much larger apartment deals.
Yeah. And you've got quite a portfolio today, correct?
Yeah, I think our current portfolio is around 400 or 500 units. We've been invested in over 1,200 units, over $100 million worth of apartments. Again, we've gone full cycle on a number of those assets. But the stuff we have in our portfolio is doing well. We're excited to expand. I know a lot of folks are nervous about the current market cycle, but we're actually pretty excited and, cautiously optimistic, but we're excited because we felt like, the pricing guidance is coming back down to where our underwriting kind of naturally fits. We think this is a great time to, add to the portfolio, especially as some folks are sitting on the sidelines, this is a great time for some of the, I'm going to say smaller, quote unquote, smaller players, but this is a great time for some of us to get in there and add to our portfolio.
Nice. And are you seeing increased deal flow right now?
We are, and the thing that's incredible is that conversations we're having with brokers are almost 180 from the conversations we were having 12 to 18 months ago. 18 months ago, they had all the juice, I mean, they had all the power. They had 20 offers on a deal. They didn't need you. You were going to have to jump your number to make something happen. And now I think both brokers as well as owners recognize where the market is. And we were waiting on this realization to catch up, right? I mean, for the last year, at least the last 6 to 9 months, we've all been like, there's still this imbalance of where, sellers think the market is and where their prices are and where buyers think the market is. And now we're seeing that come a little bit more in line. And the reality is, if you don't have to sell today, you're probably not selling. It's just not an ideal time to be a seller. But there are a lot of people who have to sell. We're seeing stuff where people, maybe came in a couple of years ago with their deals. They've got a rate that's expiring. So, the loan's maturing. They've got to do something. The new loan won't match. Interest rates over the last 2 years have hurt their ability to implement their value add strategy. So we're seeing opportunities now that, we probably would not have seen at all over the last 12 to 24 months. So we're definitely seeing more deal flow. We're excited for that deal flow. But we also want to make sure that we're being conservative and taking a look at the market and understanding worst case scenario as well as what the upside could be.
Yeah, sure. And are you doing anything to really mitigate risk in this environment?
The biggest thing for us is making sure we focus on cash flow first. I think for us, that's never changed. That's been one of the challenges we faced is a lot of groups will go in and even if a deal has a negative cash flow out of the gate, they believe they can create the value over time to make that up. We've never really looked at it that way. We always want to find deals that do have positive cash flow where there's a clear path for us to add more value to that property and extract that value either through a refinance, a sell, or simply have that equity built into the project and then sell whenever it makes sense. So for us, that really hasn't changed, but I think that philosophy and that approach is becoming more and more popular. And I think not everyone, but a lot of people are thinking about it that way now. So we're seeing that where we're coming in on some of these deals is more in line with kind of the market. I think in the past, people were treating it almost like flipping a house, right? Where it's who cares what I pay for it today, as long as I can make some money, I'm good. And now people are saying, wait, what's the going in cash flow? What's the going in DSCR? So we're spending more time actually make sure the going in DSCR is positive. It's going to cash flow day one, but we still want that path to create value for our investors. Because to me, that mitigates the risk, especially if you're buying these assets at a higher interest rate. Because if it works today and rates stay high, well, you still got a good cash flow project, right? Especially if you're going to add value. But if rates come down, well, you've just built in even more equity for yourself, and then obviously an opportunity for that next buyer.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, we're seeing the same thing, right? Where operators, if they're focused on actually doing that value add, and you can start driving up that value as soon as you take over, ownership of the property, it really increases the value of the asset, right? But I think, in the past 5 years, since the market was so strong, there was a lot of people probably just betting on appreciation. Right.
Yeah.
But, some of those people, like you say, are now kind of upside down right now, or it doesn't make sense based on the underwriting that they put in place 3 years ago. What do you, from a, debt perspective, how are you approaching, kind of the debt markets right now? Rate caps are very expensive in terms of the acquisition. So, how are you playing that out right now?
Yeah, it's a great question. I think it's really important to select the right loan based on the business plan for that product. I know a lot of people are of the mindset of, we only want to use fixed rate, or hey, you don't hear it as much today, but some people, they want the flexibility, so they're only using bridge debt. I would say that for us, we want to understand what the business plan is for that property. And I'll give you a clear example. If you have a clear path to add value and a substantial amount of value, and you can, validate that based on comps in the marketplace, then there's still an opportunity to use bridge, because you don't want to lock in a 7% interest rate for 10 years where you're going to create, a ton of value, and you can do nothing about it for 10 years. So in that scenario, I think bridge may play a role. I would push to say you have to really be able to validate that you can create that value. So, and it's not just $50 rent bumps. It's got to be substantial, right? It's got to be a substantial amount of value that you're going to create. If you're not going to create that level of value, then I do think, fixed financing makes sense, and give yourself some flexibility. Maybe you pay down the prepayment penalty. Maybe there are things you can do where if the market does heat up and you want that flexibility to sell early, you have that ability, or even to add a supplemental or to have an assumable loan. So there are things that you can do there that give you some flexibility. But I would say for us, at least, we're trying to make sure that we understand what the business plan is for that product. And then we want to match the loan with that business plan.
Yeah, that makes sense. And what would you say, John, is your philosophy around hold period? Because it is kind of interesting. Some operators have different models where, some will exit, say a 3 to 5 year exit, build the value, right? But others are actually really in it for the long term. They might do a refinance in the future to get some of the investor capital back out, but they go in with a lower LTV and they look to just, cash flow it long term.
Yeah, it's a great point and great question there. So for us, I'll go back to the business plan. If you're looking at a particular property, I would say, generally speaking, newer, nicer assets, we are comfortable holding longer term. For older assets, we are typically looking to exit those deals a little bit earlier. And for us, a 5-year hold is kind of our standard, and then we adjust accordingly. There's a deal that we're getting ready to do. And on that deal, we have an 8-year loan, which is unique. This entire loan is actually unique, but it's an 8-year loan. It's assumable. It's a crazy low interest rate. But on that deal, we are projecting a 5-year hold. But in the back of our minds, we're going to explore a sell at year 3, because we want the next buyer to actually have the ability to come in, assume this loan, and have 5 full years to keep this really low interest rate loan for themselves. So stuff like that, I think, comes down to it. And I think you've got to, factor that into your plans as far as the length of the hold, how much upside you have. It's also, for us, we try to take the long view, and then we want to be opportunistic if the market affords us that, right? So we don't want to sell just so we could say, oh, we got a 20% IRR for investors. Like, we're not really trying to play into the vanity metrics or just check the boxes to say we did something. If we've got a deal that's performing and we don't have another deal or a better solution or another opportunity, we're going to keep our investors in that deal, right? If we've got a deal that maybe is not performing as well for whatever reason, then yeah, we may decide, hey, it's performing, but it's not maybe achieving the standards that we've set. Then we may say, hey, maybe we trade this one out and see if we can, find a deal that better suits our investors' needs. So I think some of that comes into play as well. But generally speaking, we try to take a little bit more of a longer term view and then be opportunistic if the market's in our favor, versus going in and assuming we're going to be in for 2 or 3 years. Because I think that's fairly risky, because who knows where the market's going to be in 2 to 3 years. I'd rather have the ability to be flexible, and let's just see where it makes sense for us to sell.
Yeah, agreed. I think there's really pros and cons, to both scenario, right? And looking at it from the investor perspective, sometimes if you have to redeploy capital, right, you've got to go find another deal, right, and get that, capital to work for you. And if it's been performing well in an asset, why do you want to disturb that, right? But on the flip side, one thing I think a lot of people don't really think about from that investor perspective is that, if you transition in 5 years, right, you start the clock again on your bonus depreciation. right? So from a tax standpoint, it can be better to be turning that capital, right, versus holding on to it longer term.
Yep, absolutely. And the other thing that is, and this is something that a lot of people don't really think about, take what you just said about being able to start the clock on bonus depreciation. Well, for a lot of the depreciation, it's 5-year depreciation. So if you wait 5 years, you don't have to recapture that portion. And a lot of folks don't think about that. So if you sell in 2 years, you've got to recapture a lot of that depreciation. But if you sell at 5 or year 6, a good chunk of that you won't have to recapture. So there are some perks in doing that, and not to get into the loan pay down, right? If you're not an IO only loan, and you are making the principal payments, well, you're also building equity from operations. So
Right.
there's I don't want to say safety, but there's some security in having an asset that is building equity just from making the monthly mortgage payments, because now you have that pay down on the principal. So whenever you do go to sell, there's more value there for the investor. So there's definitely some perks in holding on longer. But I think to your point, some investors certainly want to, rinse and repeat, and there's the time value of money. And that's what IRR is calculating. So we certainly want to make sure that we are keeping all of that in mind, and being, like I said, opportunistic, taking all those inputs, and then deciding when it makes sense to either exit or roll into a new investment.
Yep. John, tell us a little bit about your market. Typically the Sun Belt kind of gets all of the noise, right? Everyone's in the Southeast, Southwest. So tell us a little bit about your market.
Yeah, so I'm based in the Midwest, and I've got a lot of love for the Midwest, right? The Midwest is misunderstood. People just, they don't understand it. I talk to people all the time, and friends that I know, and they think the Midwest is only cash flow and there's no appreciation. And I think some folks, when they hear Midwest, they think, Toledo or Detroit or, Akron, or these places where all you can get is, a 10% cash on cash return. And that's what they're looking for. And certainly there are markets like that, but I would argue you have markets like that in every major metro. The Midwest has some of the strongest growth markets in the country. Columbus is a very strong market. Indianapolis is a very strong market. Louisville's good. Cincinnati's good. What I would implore people to think about is the balance of cash flow and appreciation, particularly at a time like this. There are some markets that are boom or bust. We talk about some of those coastal markets, Phoenix. They're markets out, not just pick on Phoenix, but Phoenix, Vegas. Some of these markets are very cyclical, right? And when the market is doing well, I mean, we saw 20% rent growth in some of these markets, right? I think 24% in some markets. That's amazing. It's not sustainable though. And if you go up 24% and then come down 10 or 15% the next year, how valuable is that for you as an investor to be able to predict, the future growth? So one thing I like about the Midwest is it's sustainable. It is, I don't want to say predictable, but you can project with some accuracy what the growth rate's going to be, what the demand is going to be. There's not as much new development, which as an investor is good because that's less competition from new housing stock. If you buy a 1980s building, but every year there's brand new Class A buildings going up around you, well, your property is not going to be as attractive. You won't be able to compete. Versus in a lot of our markets, they build Class A buildings, but for the B class area where we invest in, it's really difficult to build, B class products in the Midwest that are going to be comparable. So typically speaking, if we're going in with the value add strategy, we're going to have a fairly nice product that can compete with some of the newer, nicer stuff. Not exactly, but it's a nice complement or a nice alternative to those assets. So I love the Midwest. We still stick to the fundamentals. Again, we want to invest in markets where we're seeing population growth. I still want job growth. I still want to see rent growth. I want to see overall appreciation. I want to see demand growing. I want to see which employers are coming into the markets. One thing that I love about the Midwest are the growth is usually in sectors like logistics and healthcare and things that tend to be recession resistant. You juxtapose that with maybe some markets that are driven by technology or driven by hospitality and travel and leisure. Those markets tend to suffer more during a recession. So I like the fact that, if you think about it more plainly, people in the Midwest live in the Midwest because that's where they're from. They got family there. They're comfortable there. you're typically not, I mean, Chicago's different, but people typically aren't waking up and just deciding they want to live in Louisville, right? You're not moving from California to Louisville because you just want a culture change, right? You're probably going back to Louisville. Maybe that's where you grew up. Maybe you've got family nearby. So those people are staying for reasons that economics won't really impact. Again, when I look at a Vegas or Phoenix, and this isn't to pick on those markets, but those people are typically going because they got a high priced job there, right? There's a tech company there. They graduated. I'm going to move and go live there. Same with Chicago and New York and these cities too, right? But they're moving for that. But as they start to settle down, have a family, you know, jobs disappear or whatever, their layoffs, well, there's no reason for them to be in those cities anymore. So I like the Midwest just for the stability of those markets. And a lot of it is just with that underlying understanding of why people live in those markets and why they choose it to call it home.
Yeah, that's a good breakdown. I was going to ask you about the demographics, right? Because we all hear about people, moving to Texas, moving to Florida, the Carolinas, right? But what is the actual population growth in the Midwest? I mean, just generally speaking, right? Is it growing, or is it maybe at a slower growth rate, or what does it equate to?
Yeah, it's definitely growing. It's at a little bit of a slower growth rate, and again, the Midwest is not kind of a one single market. So I would say when I'm looking at it, I'm looking at, again, the Columbus, Indianapolis, Louisville, Cincinnati. Those markets are seeing really good sustainable growth. They've got different jobs there, different industries that are driving it. I'll take Louisville as an example. Healthcare, logistics, UPS is there. FedEx has a big footprint there as well. They've got some automotive manufacturing in that market. So if you just think geographically, look at it on a map, well, it makes sense for logistics to be there because it's an easy way to access the Northeast, the Southeast, the West, right? You can get to a lot of the parts of the country in those areas. Cincinnati, Amazon built a $1.5 billion airport hub, right? An air cargo hub of their own so that they could get in and out and do same day shipping. So these are the things that are driving the parts of the Midwest, not to mention healthcare and some of the other industries there, Eli Lilly's in Indianapolis. So we have a lot of those kind of things that are sparking growth. But again, it's not unilateral. So while I'm born and raised in Cleveland, I love Cleveland. You'll never hear me say anything negative about Cleveland. Unfortunately, Cleveland as a macro market, the metro itself is not growing. Okay, it's stable, but it's not growing. So that's one of the things that we have slight concerns about Cleveland, right? Then you get into the ease of doing business and all the policies. So there's some markets where we don't focus on those markets for reasons like that. But the markets that I mentioned, I would match them up with some of the more popular markets in Texas and in Southeast region. And again, it's not Dallas. No one's trying to say that it's Dallas. But I think too, when you look at the competition, when you look at the new development, I think it stacks up. Most of those markets stack up very nicely with what you're seeing in some of these other metros.
What are you thinking about 2024 right now in terms of, where is the market going to be? Where are the opportunities going to be?
There's a mantra you hear from a lot of people, which is survive till 25, right? What I would say is I think is going to be a great opportunity for those who are looking for deals and looking for opportunities. But you probably don't want to sell in 24. You probably want to wait until the market settles down, where interest rates are going to be in a place where people know kind of with some level of certainty what to expect in the next 12 to 24 months. You can read varied reports on where rates are going to be. One more rate hikes have stopped. Who knows? For me as an investor, I go back to where we were before. Have a longer term view. Let's make sure we have deals that cash flow. We have deals that we have a business plan that we believe in. Deals that we have a business plan that has flexibility built into it. And if you're doing it that way, you're a little less concerned about trying to time the market and where things are going to be in 24. It doesn't mean that you're, putting your head in the sand, but on the same note, there have been people waiting on the sidelines since 2018, right? I mean, just 2018, everyone told me, oh, the market's going to collapse. You want to sell all your stuff, right? Rates are going to go. And then COVID hit 2020. Okay, well, now it's really going to hit, right? Now is the time. Everything's going to crash. You got to sell your stuff and wait. And we saw everything go up. So I've been hearing this for years and years and years, and it's not to say that I want to dismiss it. I believe it. However, I think the key here is to find the solution. The solution is don't worry about selling in 2024. Figure out deals that give you flexibility. If you have deals in your portfolio now that don't have that flexibility, you need to be pushing it now, either refinancing or looking to sell or rearrange your portfolio. But now is the time to have flexibility with every single asset in your portfolio so that you can take control over whatever happens in the market. And you're not worried about where things are going to be in 2024. And more specifically, like, oh, we got to refinance by May or whatever the time frame is. You want to have that control so you can sleep at night and just make sound business decisions with the assets in your portfolio.
Absolutely. I think that's really the beauty of real estate, right? If you have that 3 to 5 year window, that hold period, you're able to have the flexibility with the asset to kind of plan long term. And especially when you kind of compare that against the equities markets, right? Which most people are always trying to react to. And, you look at investor psychology, and that's how investors are losing, right? Because they're getting emotionally involved and, this went up, this impacted this, I got to change, I got to move, right? But with real estate, it's a slower, it's a more systematic, type of approach. And I think it's more of an all-weather approach as well.
Yeah, Dave, there's a quote that I love, and I definitely have stolen it, but real estate, the values only matter on 2 days: the day you buy it and the day you sell it. And if you can control that second day, you've got all the power. The problem is if you don't have good cash flow, or you're in a situation where your loan comes due, well, you don't get to control that second day. So for us, our whole philosophy is control the day we sell. And if you do that, you'll be okay.
Love it. Love it. John, if you could give our listeners just one piece of advice about how they could accelerate their own wealth trajectories, what would it be?
I would tell them to figure out what their biggest challenge is and then think about a solution. Said differently, not to get into mindset too deep, but it's really important to ask yourself, how can I? How can I do this? How can I save $1 million? How can I add, $10,000 a month in passive income? If you say, how can I, you're setting up the solution and the answers. Too many people, I think, start with, oh, I can't do that, or I don't have that, or, oh, it's easy for John to do it, or it's easy for Dave to do it. And they dismiss it and they cut it off before they actually have a chance to brainstorm potential solutions. So I would urge them just to ask yourself, how can I, and then you fill in the blank with whatever it is. How can I invest in real estate? How can I add $10,000 of passive income a month to my portfolio? How can I add $1 million in assets? And if you start asking yourself, how can I, now you can start to understand what those potential solutions are.
Yeah, sage advice. It's really been a pleasure having you on the show, John. Really appreciate all the insights and wisdom. And if folks would like to reach out and learn more about what you're up to, where's the best place?
Yeah, listen, on our website, we have a bunch of different resources, including a sample deal package for anyone who's looking to invest passively and maybe just wrap your head around what to look for in a deal package. But you can go to casmoncapital.com/sample deal. And then also on casmoncapital.com, we have our podcast, Multifamily Insights, which Dave has been a great guest. So be sure to check that out whenever you can, but casmoncapital.com.
Awesome. Thanks again, John. Really appreciate it.
Thank you, Dave.